Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In leading professional service firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client. Welcome to Compound Insights, a podcast by CFA Society New York. I'm your host, Gary Farber. Today we're welcoming to the podcast Luis Viceira. He is the J.O. Light Professor of Business Administration at Harvard Business School and a co-chair of the HBS Investment Management Program. Luis has been a member of the faculty at Harvard since 1998. His research and teaching focuses on the areas of investment management and capital markets. He is also a research associate at the National Bureau of Economic Research. Luis, welcome to the podcast today.
Thank you so much for inviting me, Gary. It's a pleasure to be here.
Luis, your work runs the full spectrum of market topics in investment management and capital markets. Can you share with us your perspective on today's markets and what you believe are some of the key themes?
I think we are going through a really interesting and very important time in the history of capital markets, at least in the history of capital markets of the last 40 years. Because, what we have is a very long period of declining interest rates. And not only nominal interest rates, which they have declined also for about 30 years because inflation was declining, but also real interest rates. So we have gone through a period where, everyone in this podcast that remembers were they all enough to remember when they get their first mortgage in the early 1980s, lots of people were getting mortgages at 20% interest rate versus at some point where mortgages were at 3.5% for some people. And that decline, happened between the early 1980s all the way to 2022. And it was nominal rates and real rates. One way to look at real interest rates is the yield in the US case, TIPS. When they started about 3.5%, 4%, even 4.5% back when they were first issued in the late 1990s. I actually did my first case study, and my dissertation was part of that, looking at real interest rates. They went all the way to 0 or even -1 in some places by, the bottom in 2022. So very long decline that has passed on financial economists, market practitioners. Why is this happening? You probably remember all this say we're in a permanent era of very low and even negative interest rates. And suddenly, come 2022, rates take a huge U-turn. And, the yield on TIPS goes all the way from 0 and even slightly negative on the long end of the curve, all the way to 2.5% or 2.7%. Where it went at some point and it's still there today. And might say, well, what is that? It's not important at all. Well, I encourage people to look at, at what prices TIPS or even nominal treasuries in the 20, 30-year range issued in early 2022 or late 2021, what they are trading today. And some of them are trading at 60 cents on the dollar. That's a cataclysmic change. Why? Because, it's a cataclysmic change in interest rates, plus or times the duration that these long-term bonds have. So it's a really important change. And the question is that a temporary thing or is here to stay? By the way, it's a normalization of rates, right? Real interest rates have been always in the range of 2%, 2.5%. Historically, we are back there. And that's completely changed the set in the mindset in capital markets. And so, we had to, this is something that has been ignored actually by the popular press, the financial press, about that change. They have been focusing mostly on the nominal rates, but not on the real rates. And the question is, what are the trends that might have driven that change, and what might make that change to stay? And that has very important implications for investing, by the way, because you think about when we were in interest rates, say you were an endowment, and you were with interest rates of 5% in 1995, approximately, right? Typically, draw for an endowment is 5%. Basically with a portfolio of treasury and a little bit of equities, you could do, right? Think fast forward what happened around 2020, 2015, 2012, when rates were zero. What was happening? You had to take a lot more investment risk to kind of being able to get that kind of 5% return that you need to make that payout that is typical for an endowment or a foundation, right? And we're going back to those older times where treasuries are paying rates, especially real rates that are a lot higher, and you can do a lot more with taking less risk. So in some ways, this is back to some reasonable times for investors. Of course, for those who are borrowing costs have gone up. But for savers and investors, this time is new, is a time of normalization, and a time where it's worth thinking whether this is gonna stay or not. It's hard to tell where real interest rates are going to go in the end, but I think there's a couple of phenomena, or three phenomena has happened, which I think suggest that these higher real rates might be here for longer. And they are all related to, the geopolitical situation and the technological revolution that we are experiencing, right? Which are requiring a lot of demand for capital that is pushing real interest rates up. It's very much in the press about the enormous amounts of capex that's going on, especially with the people building the companies building the infrastructure for AI, data centers, and all of that. That is accounting today. Some of the capex forecasted for this year could be up to 2% of US GDP, is driving a lot of the growth in GDP. That is the kind of demand for capital that was typical back in the 1960s, for instance, when we were building, or the 50s, where we were building factories and petrochemical plants. That was the thing then. Lots of demand for capital. Contrast that what happened in the late 90s versus the first 20 years of this century, where we got a technological revolution, but was low intensity in the demand for actual capital, right? Think about the stereotypical image of someone starting a startup in Palo Alto and some apartment in Brooklyn, right? That's still happening today, but that was more or less the characterization of what was happening in the late 90s and early 2000s. And today we are back to something that looks more like the 60s and 50s. It's a lot of capital, a lot of demand for capital that is competing then for other needs, like the federal government needs, that is rising interest rates. The geopolitical situation is another example that is getting a lot of developed economies, even on their own, or even for pressures from the United States, to increase their spending in defense, which typically requires a lot of capital. And that is another, I think, contributor to what's happening in interest rates. It's very interesting that the U-turn in rates was super fast, and it happened in 2022 and early 2023. That happened to be when AI was starting to take off. You remember that was when Microsoft suddenly announced that they are giving a total of $3 billion to this OpenAI new company to fund their investments that they need. That was like a shock in the markets. And then, quite frankly, that's when the Ukraine war started and totally changed the mindset of where the new geopolitical situation might be, and what the capital needs for that might be. This might be all spurious correlations, as we economists like to say, but it is at least suggestive And with that, it's a new era where higher rates, they're here to stay, better times for investors. They have now more opportunities to get more bang for their buck, assuming less risk. And so there's more competing for this for capital that's happening in capital markets. So I think this is a very key thing that has happened, is likely to stay here, and is very, very different in flavor and in substance of what happened in the last in the 90s and the first 20 years of this century. It's really interesting, and it's really important, and it's linked to what's happening also in the stock market with the AI revolution, of course.
And shifting to equities, obviously been a very strong market environment. Anything besides stock performance that's been surprising to you on the equity side so far this year?
It's the nature of the booming stock market that is what's making people think about the current valuations that we are seeing, right? Some people, I think there are two things that we need to distinguish. One is the long-term trends. And the long-term trend is that the market seems to be anticipating that this enormous spending that we're doing in CapEx, these companies are doing, is going to pay off in terms of higher productivity in the economy. And that is actually something we have started to see quite a bit in the last 3 or 4 years. Productivity has been taking off. And that means more profitability, and that means better times for companies. So that the market is sort of being, you need to distinguish in the market the short-run volatility and the short-run changes in valuation that might be driven to a large extent too by market and investor sentiment, but also this long-run trend that is, at the end of the day, what's going to determine, as Benjamin Graham used to say, at the end of the day, the stock market is a weighting machine. It's going to be driven by fundamentals. And these fundamentals are very intriguing, and the market is sort of discounting that this is here to stay, and that's going to have a very serious impact on productivity, on growth, and on profitability. And in that sense, but on top of that, we might be living through maybe investors in the short run getting too optimistic about the prospects of this, or how fast this is gonna come. So there is obviously a short term also pushing valuations that is assuming this is gonna come relatively fast. I think a lot of investors are thinking about the question, I don't mind that I did miss pet.com, right, back in the 90s, but actually I do mind I met google.com. You remember when Google went public, everyone thought the valuations were completely outrageous. It was a misunderstanding of really what the business model was, and Google never came back. It just went double the price like every 3 or 4 years. And it is a bit of that these companies here don't look like pet.com, but more like google.com, and that this is here to stay. And I don't want to miss that boat. And that might be, leading to that, on top of, cult of personalities, if you want, and all of that. But, I don't think that's the case for Anthropic. And, the company, certainly when it goes public, if things continue the way, it's going to also go more like the waves SpaceX, right? So there's this short-term thing that, there's bubble signs, definitely. But, bubbles don't come out of thin air. They used to come from some fundamentals. And the fundamentals look interesting, to say the least, today.
And Louise, you've referenced a couple of times artificial intelligence. What's your view as to how AI may change the management of institutional portfolios?
Well, generally, AI, I think, is going to do to the services sector was what robots and IT and a bunch of other things did to manufacturing. It's going to, it's well known that the services sector has been chronically unproductive, very low productivity and very low productivity growth relative to the manufacturing sector. And I think AI, in some ways, we can think of that as the industrial revolution of the service sector. It's going to increase productivity very, very rapidly. And it's intriguing to see how is that happening. And I think we are entering the second phase. We are building the infrastructure that allow AI to do these things. And now we're going to see how companies, use that, and especially in the services sector. And of course, asset management, portfolio management, investing is very much services. And we're starting to see some of this impact of AI on that. I think we are starting to see a lot of applications that go mostly at making the processes a lot more productive, a lot more dynamic, a lot more efficient, right? Think about, applications and companies are out there that now using either public data or your own proprietary data are able to produce very decent analyst reports on the spot, right? That was something that required a legion of analysts and people digging. Now, even you yourself or me, we can go into Anthropic and say, here's the data for this company. And if I have access to these databases, go and build me something. So, and that thing gets produced in a matter of minutes sometimes and can track. So these things are going to have a huge impact, I think, on how we think about, for instance, active investing, company analysis, and all of that. We still need the minds, at least for now, that kind of make good use of that information. But collecting the information and putting in ways that is understandable is changing a lot. Used to have people who had to pour through 10Ks, footnotes, this and that. Now, we have agents that can read that and produce and digest that information very quickly for you. In the asset management and financial advisory side of things, for instance, right? Now you can have like a very big wealth advisory firm. We all know who they are. They have a long history of helping clients, right? Those things can be fed to LL models. And, and they might, the new clients come in and, with, again, the help of a lot of these applications, they can enter, first of all, their information very quickly and easily. And then, the system can read what has been the financial advice and the advisory services that are being given to clients similar to that client, and very quickly help the wealth advisor to produce advice and things that might take, for some people, a week, maybe 2 weeks to come up with something, maybe within 2 hours now. Those are things that are possible. Tracking the markets, producing signals, all that kind of thing, I think, is here to stay, and it's increasing the productivity in the asset management industry in every dimension, and people are figuring it out ways to actually do it. I won't name people, but or projects, but one of my students in my class, I teach this elective class in our MBA program called Investment Management and Capital Markets, had a great idea about investing in a sector of privates, and through the second semester was able to develop quite an interesting product that already has 3 clients, and it's actually helping on a certain part of these private markets investing. It was he and another person got together. It took them 3 months to develop a prototype that now is working pretty well and already has 3 clients. So it's quite interesting how fast these things are happening. I think that's going to have a very deep impact into our area, which is asset management and investing.
Is there a risk, though, on the investment management side, if everyone's using the same tools, that the consensus viewpoint becomes very more prevalent in the market because everyone's sort of using the same tools, basically?
I completely agree. And therefore, this actually presents a very interesting dilemma, because it's still going to matter, at least for now, for sure, judgment, right? and people getting that information. By the way, it's going to vary also the output on what kind of data you can feed, right? And some firms have proprietary data. But conditional on that, yeah, you might end up having output that's similar across firms. So that's what I'm saying. The productivity comes in having these reports done much quicker, but then the element of human judgment and wisdom becomes even more important. And that's what I think in business schools we need to teach, in colleges we need to teach, is going back to the roots of exercising judgment in analyzing information. And but here's the catch 22, right? Usually people, before they become portfolio managers, start as analysts, right? Where they digest all that information, they become extremely familiar with that information. They develop the judgment, not only what they learn at school, but also, very importantly, at work. And the question is, if we don't have these people now going through that process, how do we get those senior people in the future? So I think that's a thing that I'm intrigued and interested in see how the industry is going to evolve to actually identify, people with good judgment, with great intuition that can make the most of this information that's going to be now digested by essentially AI analysts, right? And that thing is, I would love to hear what you think about, Gary, but I think that's not a very intriguing process that we're going through. And I don't know how's that going to play out, quite frankly.
But you've also studied, interestingly, some of the most sophisticated asset owners. In your mind, XAI, what separates the best performing institutions from their peers? What distinguishes them in the market?
I think the most, someone could say the most successful organizations have been those that got the luckiest. And this one thing that is a characteristic of our industry. Is very hard to tell apart skill versus luck, definitely. But I think there is an element there that the institutions, the institutional investors being at the frontier, have been good at identifying where are the areas of opportunity that have not been yet sufficiently explored. And there are two ways it goes. One is at the manager level, of course, they're trying to understand early on who has that talent and that skill and that judgment that we were talking about. But also in terms of areas of investment and having first of all, the risk tolerance at the institutional level and the skills and the flexibility to sort of go into these areas and be first, and therefore in being able to take advantage of that. I think there's a good argument today that we're reaching a point of maturity. Some people would say even saturation in traditional private equity investing, right? But the reality is, back in the early 1980s and the 90s, when this industry was taking off, who was investing there? And it required a combination of judgment. It required a combination of institutional support and risk tolerance and flexibility, and to hire that judgment and allow that judgment to do that. I think the most successful organization, institutional investors, I think, have been investors being able to do that. Always going into the next area of, and within that, of course, manager selection, if you want, and all of that. But a lot of that has been that insight, or where are the opportunities, or where are we heading? And so, when I meet with endowment managers and all of that, I always like to ask them, where do you think at these areas today, right? Of course, they kept mum about that because they're gonna not share publicly, but I think that's a characterization of these organizations.
Let's shift into the macro. We have a new Fed chairman. What do you think that means for interest rates and markets?
I think the new Fed chairman is someone with a very solid background. I think there is consensus that he could make a good Fed chair. I think there is consensus too that this might the challenge might be if what happened within the next 2 years, if there is, a market crisis or, some macroeconomic situation that requires, say, moving interest rates and doing Fed policy that might not be, in agreement with maybe what the Treasury or the government would like to do. And how is that new Fed chairman confront that dilemma, right? But the new Fed chairman could be, and giving the background, the history, and the qualifications, someone who could do a reasonable job as chair of the Fed. I think the main risk in the economy now today and for the Fed is a risk of, first of all, inflation. And we had two types of inflation coming our way. One is, supply shocks, right? You saw the CPI number that came yesterday, mostly driven by energy, right? Given the situation in the Middle East and everything, that's a typical supply shock that we have seen. By the way, not as important as in the 70s, that shows the resilience of the economy to energy, how we have been able to get other sources of energy in play, and we are a lot less dependent on oil, but nonetheless, an energy shock. And but also inflation shocks driven by what we were just talking about, this growth in the economy driven by capex, this demand shocks to inflation. And so there's a risk of, inflation staying for a while quite above the 2.5%, 2% target for the Fed. And what the chair is going to do about that, especially in the next 2 years. I think that's a very important challenge. This plot that is circulating, I'm sure, Gary, you have seen about the parallel between the late 60s and 70s and today, right? Where, inflation is sort of not in the level, but certainly in this thing. We have had, what happened in the 70s was we got 3 waves of inflation. And what happened is inflation expectations stay more or less anchored through the first 2 waves. What happened is when the third wave hit, is when, both for businesses, let's just be clear, businesses and consumers, not just consumers, inflation expectations got an anchor. And we got this stagflation shock of the late 70s. And so the question is, so far, we have had 2 inflation shocks that kind of parallel actually what happened in the late 60s and 70s. And inflation expectations have remained reasonably anchored. But what happened if we get a big third shock of inflation and these inflation expectations get an anchor? And then, you might find yourself, I hope not, a situation where inflations get out of control for a while. And then the reaction to get not so much inflation, but inflation expectations down and anchor requires very harsh monetary policy. That's what Paul Volcker had to do when he joined. And that's what led to, if you remember, as people remember, we can go back into just his data and history books and the press from the early 1980s with mortgages on short rates that went all the way to, high, teens, and even at some point low 20s in some cases, right? And the levels today are not quite there, but could we get a period of high inflation, and maybe could that lead to stagflation? That's a risk, a tail risk in the economy. The difference with them, and I think that's an important one, is whether AI end up being paying off. I think that's the economy. The economy now is like in some ways, a giant bet that AI is going to pay off in terms of higher productivity and maybe not a big impact on employment, right? Think about fiscal deficits. I think the way that with the situation with the federal debt, and the fiscal deficit is a big bet that, on AI really leading to growth and productivity, that will take care of the high levels of debt. If that doesn't happen and AI benefits, which I think are going to be, I'm optimistic. I might think that the market is more optimistic than I am, but I'm generally optimistic about the long run trends here. I think will be more than others, I think. But if did that not happen, then we would be in a very dire situation with probably very high inflation, low growth, and maybe a difficult stagflation situation that will pose very big challenges to the Fed and the chair of the Fed and whoever is next in the federal government to deal with those issues. If everything works like it works in the 50s and 60s, if you remember, the last time and the only time essentially that the US has been with levels of debt to GDP above 100% was the end of World War II. And basically, 15 years later, not even 20 years later, we are taking those levels to 40%. And that happened without necessarily raising tax rates. I don't think it was a big deal. That did not happen. It happened naturally just by collecting more tax revenue. And where was this tax revenue? Why was tax revenue being collected more? Just the growth that happened in the 60s and 70s, 50s and 60s through the mid 60s by pure growth, given the boom in productivity, mostly driven by manufacturing productivity that happened in those years. And that might well play out today, that we had this impact on services, which is now the dominant sector in the US economy. And we might get, that thing not causing permanent large unemployment, but just shifts in employment across sectors like it happened in the 50s and 60s. And, tax revenue growing and taking care of that. But everything looks now is, from fiscal spending to monetary policy to the markets, all hinging very strongly, I think, on really this enormous capex that we are seeing in the economy, which is propelling the economy as we speak today, is going to continue in the forms of higher productivity and employment.
And now a word from our sponsor. If you work in a financial services firm, this program could be worth a look for you or someone on your leadership team. Harvard Business School offers an executive education program called Leading Professional Service Firms, a 5-day in-person experience held on their campus in Boston. The program is built around real-world examples and is designed for senior leaders dealing with the day-to-day realities of professional service organizations, setting strategy, developing talent, and managing client relationships. You'll spend time working through real company challenges, looking at how firms align partners, build culture, and continue to grow in competitive markets. To learn more, visit hbs.me/client. That's hbs.me/client. I mean, do you envision a scenario, though, where public debt levels continue to rise? And at some point, what's the scenario where those financial dynamics begin to materially affect asset allocation decisions?
Well, that would be if, say, the tail risk here, right? That the translation of all these AI investments do not translate into higher growth and employment, and there's a slowdown. And without a changing in tax rates or anything, deficits explode, and that has to be funded by public debt, and that has, makes very tempting to monetize, that debt, and that leads to a situation of stagflation, where interest rates are going to be high. Nominal interest rates could be very high, but real rates not, and that would not be good news for investors. Back to the 70s in some ways. I think that's the tail risk for investors as well. Then we are in trouble, and it's going to be a situation where will not be good either for the bond market or for the stock market. That was also the situation in the 70s, right? Where it was not just the really bad times for the overall bond market, given the high rates and high rates of inflation, but also for the stock market. People forget, we have been living through a period where, the markets have been experiencing a lot of tail events of very big drops in the valuation, but also very fast recovery. And I think people have got used to that. People should know that between 1971 and basically 1983, in real terms, the stock market in the US went nowhere. In fact, it declined. And that was a period of 10, 12 years of nothing. And that was the stagflation period. I think we need to remember that, that's the tail risk here. I'm more optimistic than that, but, you are asking me and say, what are the risks? I think that's the tail risk. And it's not going to be good times for either equities or bonds, or private equities, by the way, or private equities. If markets go nowhere over 10 years, that's going to impact privates as well, right?
You just touched on an interesting topic here, Luis. Portfolio construction, right? We've talked about geopolitical, technological. If you were building an institutional portfolio today, how would you approach? What would be some of your underlying principles to doing that?
I mean, I think in some ways we need to, and especially in light of this enormous wave of IPOs that is happening now, which might not be a big wave in terms of the number of companies, but certainly on the size of the companies going public. I think public markets have been a little bit abandoned by many institutional investors, and they might come back in play. I think in real rates stay where they are, and inflation doesn't get out of hand, treasuries or, fixed income is back in play. And I think the role of privates might get somewhat diminished, at least traditional private equity. I think there might be still a lot of room for venture capital, given what's happening on the biotech sector, given what's happening on the AI sector. A lot of these companies try to make the most of these new AI tools. But that does mean, I don't think that means at all that private equity is going to go. It's just like it's going to become one more piece of the puzzle of how you build these institutional portfolios, but not necessarily the main piece anymore, right? So I think today it requires to go back a little bit to think about risk management and risk budgeting, rather than looking at the same time, looking what are the sectors where if we are flexible enough, we can take risk. But I think we have been a lot of focus on this thing about not having a discipline, risk budget and risk, allocation. A lot of things in the vibe out there was go where the best managers are, disregarding risk. And I think maybe risk management and that risk-based asset allocation and more careful consideration of risk premia and how you play that in an institutional portfolio, that might be coming back.
And as we speak today, Luis, you just touched on again also a significant topic: market impact from a lot of high-profile IPOs. And I think we've seen, when you watch the news, much speculation as to what will that have impact, no impact. What is your own take as these IPOs roll in? Will there be sector rotation within tech? How do you think that'll affect the market?
I think that it's very important to take into account what's happening with these IPOs. And SpaceX is going public tomorrow. The float is minimal. So even if the company gets value initially at 1.7 trillion, which might be, I don't know, the float is so small and the company is so big that this is maybe it's going to create upward price pressure. From whom? One is it's going to be probably very hard to short the stock because the float is so small and the demand is so high. So that's one. And we know that tends to create upward bias in upward price pressure. The second thing that really worries me is this front of prudent rules in how stocks get added to indexes. I actually expose might turn out to be a terrible idea, but I think ex ante and from a perspective of investor protection in some ways, the decision of the S&P 500 committee to kind of keep the rules is a beneficial one. But the other three main index providers are cutting down, including that stock very quickly in the indexes. In a world with indexing has grown so much and the ETFs have grown so much, there is a risk that this might create, for a period, enormous price pressure that might not be actually supported entirely by fundamentals. I want to be precise, entirely, because there's good fundamentals in these companies for sure, very good ones. And so, you think about very optimistic investor sentiment about how fast the AI revolution is going to come, how fast these guys are going to be able to put things in space and all of that. I don't want to miss the next Google. Price pressure that is not enough float to be able for those who are more pessimistic to express their views. And then index demand. That could be a recipe for in the next few weeks or the next few months for too hot price for this. It's true, by the way, and this is different from think about the IPOs of the 1990s, and now the way that these companies are going to get into many of these indices based on float. And so it's not going to be the same, right? That because otherwise it would be impossible actually today for the index funds to get SpaceX in the appropriate weighting in their portfolios. But still, even if it's based on float, I suspect that's going to create a non-trivial price pressure on the way up. So the transition period could be rocky actually in that sense. But given that, we're going to get a big chunk of now the AI economy really in the public markets. And so ignoring public markets, at your own risk in some ways, right? Without demeaning what privates can do, and especially venture capital. But let's not forget, venture capital is a very small asset class, and only very, not everyone get access to that. And that's that's where there is an advantage for certain institutional investors that have access to that. But leaving that aside, we're going to go back to square one on how we think about public market investing and how we think about risk management across asset classes. Another thing which is interesting is to see what's going to happen with emerging markets and what's going to happen with international stock markets, right, outside the US, right? And there are two arguments that people have been putting out. One, if you look at, say, you look at the emerging markets index, the MSCI one. A big component of that are things that look like AI providers in many ways. And so, but these markets at the same time, these companies are trading at much lower multiples than the equivalent companies in the United States. There's a question, of course, and they trade cheaper for reasons that might be also for a reason, right? This emerging markets is a lot of regulatory risk, a lot of expropriation risk, a lot of geopolitical risk, things that, might make these companies trade at a discount. But, sometimes the market might be discounting these companies for the macro environment in which they are rather than for the company itself. And these companies might keep doing very well, just like the US counterparts. And we might see, and some people are seeing opportunity in there. Being discerning, you need to distinguish. Emerging markets now is a very interesting mix of, say, energy champions or banking champions in these economies versus, some companies are super global, by the way, and many of them really providing a lot of supplies to the AI revolution, right? So, that is an area where it's interesting to think about today. The second area, is to what extent the AI, the first phase of the AI revolution, where the United States have benefited tremendously, how the second phase is going to play out. You could think of Anthropic and OpenAI and all these guys to be today like giant global utilities. They are providing the compute, but everyone anywhere in the world can buy that and use it. And you think about economies like the European economy or other economies with a very highly educated workforce. They could take advantage of in the second phase just as much as the US. And so, it's going to be interesting. It's also true, the counter argument said for European equities and European markets to do well, these are economies that are more heavily unionized and more heavily regulated, right? And a lot of what's happening now with the second phase of the AI revolution is to dynamize the service sector, which means a lot of employment shifting, even disappearing. And that plays much quicker in the US than maybe in the European economies are a lot. Their labor markets are quite not the same as the US labor market. But yet, we're going to see how that plays out. But that, puts in play a lot of other economies with qualified and highly skilled labor force that can take advantage. Now, they haven't built the infrastructure, but they can use and pay for the infrastructure. It's one way of thinking of these big giants today going public. It's just giant utilities providing this AI compute power, but, at a global level. It's not, like an power utility in Iowa. It can only provide, electricity and power within the confines of the state or just small area. This Anthropic can provide compute AI anywhere in the world, and anyone who can pay and they have a great idea, they can do it. I know people who are doing this now and doing very successfully in other economies, not in the US. So I think it's very interesting to see, if we think about asset allocation, how global markets actually may play out. Of course, you had the issue of geopolitical risk, which has become, I think, is not small, and things have changed quite a bit. The Ukrainian war that probably Russia thought they were going to end in 40 days or maybe even in 2 weeks is still there. And we're seeing what's happening in Middle East, and that these things might get encroached and affect these economies more than our economy, but it remains to be seen. So I think that, it's intriguing to think about global equity markets today and in global markets generally, not just the US market has been the dominant force in the last 10 years. I always tell my students and tell, tell me, because, at the end of the day, asset allocation is about long-term investing. And here's a question for your audience to tell me which markets are the winners for over the next 10 years.
And we just talked a fair amount about index funds and that, passive investment. That's obviously been on the rise. Activists is an area that you've spent a fair amount of time looking at. Has the rise of passive investment increased the importance or relevance of activists in the market?
I have a hypothesis, which I think has some base grounded on reality, which is there is a symbiosis between index and activists. Today, for instance, in the US, index investing is so important that in order for, a proxy vote to be won, that is, say, hostile to management, it needs the support of the at least 2 of the 3 biggest players in the index business. Used not to be the case, the Capital Group, Fidelity, T. Rowe, any of these guys decided to support you in a proxy vote, you could win that. Today, unfortunately, things have evolved. Or fortunately, what they say. things have evolved in the way that the indexers decide, but they don't have the means to actually decide, right? They don't have the resources. And so they need other people who can, but they don't do nothing and they just follow management. If you're a large enough company now, you are not subject to scrutiny. And, bad governance situations, bad situations like that can get, you can be chronically ill for a long time, is what I'm trying to say, right? Because there's no way to shake that thing. And where it's coming, the activists are doing the job. And I think that's where, activism is more relevant today than ever in many ways. It's been for a while. Because, at the end of the day, what is private equity? Private equity is the ultimate form of activism. You know what? I buy the whole company. I take it private. I do whatever I need to do. In fact, that's what private equity investment firms claim. We're going to take it private, and you know what? We're going to improve the company. It remains to be seen whether they actually do that. But that's the main claim. We are going to take it private, ultimately activists, and improve the operations. Good luck taking private SpaceX. So what do you need? You need the form of activism, which is a form of trying, come up with ideas to improve the operations of the company. But in order for them, and things that, maybe index investors see, but they can't because they don't have the means to do any of these things, and they are not that's what they specialize on. And these activists come in, and it's this symbiosis that I think we are seeing between one group and the other. Of course, an activist might just shoot in for short-term issues. Others not. And what the index provider or anyone voting in a proposal by an activist is to see, what they are suggesting is good for the long run of the company or good for the, or only a short run operation. And especially you're an index provider. Say you're Vanguard. Anyone who is in an index fund or Vanguard itself, by mandate of the index fund or the ETF, they need to be in these companies as long as they are in the index. So they are the ultimate long-term investor. So they should care about only the long term, and evaluate activist proposals that actually benefit the long-term interests of these companies and vote with them. And I think this is happening. The only way to actually induce change now in many, especially large public companies, private equity is too small to do that, even though they have been increasing progressively the size of the targets they can reach out for. But, many of these other companies are just too big, and it's only through very well-motivated activists that, make a good case that, the long-run prospects of this company could be better. And remember, many of these companies are doing okay. The question is whether you're doing okay, it's whether you could do much better than okay, and then come up with this proposal, but they need the indexers to vote with them to kind of take them to come up a reality, to be a reality. And I think that's a very important thing that is happening, has been happening for quite a while in the markets today, and is likely to keep happening in the future. Of course, you're seeing this response of some companies of try to avoid that scrutiny and that, by trying to change the rules of the game, trying to, domicile in maybe jurisdictions that might be more favorable to management. And I understand some of these things, but at the end of the day, we need someone who cannot discipline, complacency, right? We need that. And today, many of these large companies without that kind of activism or is going to be much harder to do.
You've just touched on throughout the podcast, a variety of transformational factors to the market or potential transformational factors. ETFs, that's something that's changed investing quite a bit. Can you weigh in with your own thoughts on the impact on investing that ETFs have had and what your outlook is?
One way at the very initial level, ETFs were a play to another way to do index investing that was an alternative to index mutual funds. And in some place, and I remember Jeff Bogle saying, why do we want an ETF? It is you have a mutual fund, right? And to some extent early on, he might have been right. He was saying, what do you need intraday? And long-term investor doesn't need to do that. You can trade in a mutual fund every day. So it shouldn't be a big driver for most investors. Of course, over time, even index ETFs have become big instruments for active investing. The proliferation of narrower ETFs have provided a lot of tools for active investors to do. You can make sector bets if you want to today. You can short. You can do, hedging. You like Ford, you don't like you like Tesla, you don't like the rest of you want to hedge the exposure of whatever to the car industry. You can short the car, the automobile ETF, things like that. And so that has led to a big proliferation of ETFs that might not be always in the interest of the small investor, but certainly they have a function and they have liquidity and they have a demand. There is a demand for that. But even for the large ones, we have discovered over time that in the US, ETFs are a much more tax efficient way of investing than mutual funds. Any way you look at it, unless the IRS changed the rules, an ETF that is well run is a lot more tax efficient than the equivalent mutual fund. So, my advice, and plus, you can now be in an ETF and your broker will reinvest the dividends. That's a big thing that was early on because, the mutual fund would reinvest the dividends for you for free. The index ETF, was a stock you had in your brokerage account and you had to take the dividends and reinvest them, which is an enormous source of long run return. You will not be able to do it. But today, they give you the reinvestment for free. And so, ETFs are, from a tax efficiency perspective, a lot better mousetrap than an index fund. So that also explains the proliferation, I think, of the growth of the established large ETFs. We just got, the BGOO, just the ETF just crossed the 1 trillion mark. It's incredible, right? I'm just hoping it stays there, not just keeps going crossing back and forth. If we control period market volatility, crossing my fingers, we won't go into that. But it's this thing. It's any new fresh money probably that even wants to go in plain vanilla large indexing should do that. And that explains the growth and why ETFs are likely here to stay. In Europe, for instance, where it has been extremely hard for indexers to get into the hands of investors for many years because the investing world was heavily dominated by banks charging very, very high fees. ETFs have been a disruptor for that market because now you could offer index funds with low fees through brokers. People don't appreciate the big game changer that ETFs have been in other markets, especially in the banking intermediated, capital markets in Europe. Now, so I think they're here to stay. They have a very important function, and unless there's a big change in IRS rules, which probably is not going to happen anytime soon, that's where any fresh new money should probably be going. We are seeing now that the tax efficiency is so well recognized that you're starting to see, Gary, the huge growth of active ETFs. But we're going to be discussing that in the program that, you refer this investment management program. A big thing that we're going to be discussing is the growth in active ETFs on Monday, actually. The program is starting on Sunday. And that is another very interesting aspect that is going to be discussed there, which is why are active ETFs growing so much? Because an ETF is very transparent. So why are active managers, the capital group that has always been reluctant to do ETFs because it's 100% committed to active investing, they just came up with active ETFs. And I think part of that is because of we're finding ways maybe around for managers to be able not to have to disclose so much of what they're holding, and just within the ETF structure. That's a very interesting things are happening in how the SEC is allowing the structure of ETFs to work. And but also I think it's because of the tax efficiency of these instruments. Really, you are an active manager today and you see the money going to ETFs because of this, and you want to still gather assets, you might have no choice. But at the same time, how you structure that in ways you're not giving the goodies so quickly, right, to the market. But hey, they are growing very fast, and some strategies are way more susceptible to be active strategies. I mean, within an ETF structure than others, right? Like quant strategies that tend to invest in a lot more, the proverbial, they are looking for pennies in front of the train. I think that's exactly what they said is, they are, it's harder to see where the active bets are actually in some of these strategies. So they are more, perhaps better fit in, at least in this initial wave of active ETFs, and say very concentrated active strategies. But even concentrated active strategies are coming up with ETFs. And I think part of that is this trade-off. You want assets. Investors very much focus on tax efficiency, on tax alpha that is today is very large, could be very large with ETFs. Then there's no choice.
You also have other innovations in the market these days, poly markets. And even though crypto is high profile, it's been around for a while, but still another innovation. In your mind, are there other areas that are sort of ripe for innovation, or things that we're really not talking about today that we could be talking about a year from now, 5 years from now?
I mean, I think maybe because people are anticipating the tax situation is going to change sooner or later, unless this big bet on AI is going to pay. It's very intriguing to see all these tax efficient strategies coming out that are already out there, and people are discussing and trying to understand. I think that's an area of growth. I think we were talking at the beginning of this podcast about where AI, might change the asset management industry. I think personal indexing, which is more like a niche area in many ways, because it requires a lot of hand work, right? AI and these algorithms derived from AI is going to be making that possible. So, the wall of target date funds, of asset allocation strategies, I think that is going to become a lot more personalized and possible. And I think definitely it's happening as we speak. And I think that area is a big area of growth. And that poses actually an interesting question we're going to be discussing too in this program next week, which is about how you think about the future of the financial advisory industry. And, just like ETFs are very tax efficient today, there might be even more tax efficient ways of doing that, more individualized to you, Gary, versus Luis, versus other people who might be listening. But technology has not been there to make it cost efficient. A lot of the, a lot of way I think about the asset management industry is about making alpha into beta. A lot of studies come and they are very niche because they are costly to produce. And of course, that, the access to that is for people who can afford that cost and then reap the benefits of that. But as technology makes the threshold, the cost go down, and the access to be possible, and a lot of alpha things become beta precisely because of that. And I think more personalization, more tailoring to individual investors is something that might be coming our way, actually. And we talk about international investing coming back into fashion, maybe, and we'll see.
Finally, Louise, we've obviously covered a wide range of topics today. In your mind, given all the variables we've discussed, what does it take to be a successful investor in today's markets?
Well, it's all the, a big thing that goes on here is who you are. We all don't have the same range of access and possibilities, right? for example, an area we haven't discussed, but I think it's an area that has grown tremendously, and we might see a lot of growth is private equity secondaries. I think that's a super interesting area, which we are actually going to be discussing in this program. I think this is a very important thing, which is hybrid investing, right? And I see equity secondaries in that. It's not totally private, because what they do is to buy LP and even recently GP stakes in typically very mature private equity funds that need liquidity, are providing that liquidity. And eventually this company is going to become public very quickly, right? In a much shorter timeline than in primary equity. That is accessible to some people and is not accessible to others, right? So, but that's an area where I think we have heard a lot, Gary, and we're going to keep hearing probably in the next year or more as the situation with private equity evolves. But you are you are an investor today, you have access to that. That has different access from what a small investor can get. So we really have to think about what is the range of investment opportunities available to investors. And I think private, large institutional investors keep getting access to these areas that I expect they're going to grow. For small investors, I think, there is good things coming. It's all mostly going to be about public markets. I personally think that so far the products have been made available to retail investors to get access to private equity it's a good idea, but I don't think the structure is entirely appropriate for them. But that might change and might become with structure more investor friendly than they are today. But absent that, for most investors today, public markets is the way to go, and assessing, whether you are again with access to active opportunities that where you actually can get alpha, or the manager is going to extract all the alpha for you. For a smaller investor, I think still indexing is probably the way to go, with more careful thinking about what kind of equities you want to do. Probably today is more important than ever to think about globally, not just locally, US. And I think think about doing it through ETFs, at least for the fresh money that doesn't have capital gains embedded. And be attentive to these new things that are coming that might be able to do a lot more tailoring to your tax and personal situation when it comes to the asset allocation. And I think we're heading that way. And it's also, I'm very optimistic about what retail long-term investors can get. On the institutional side, I think risk management has become way more important. Thinking about where the future situation with private equity could be, thinking about access, but public markets are back into play with these IPOs. I think we're going to see a lot more. We might see a lot of the institutions paying attention to public markets, either passively or indexing, or through active investing. I think hedge funds are back in play, many of them actually. I think it's a very interesting model, for instance, the platform model, which is not available to smaller investors, but certainly is to institutional investors. A lot of the money is flowing into platforms. I think if they are successful, are the next and probably way better redesign of what is used to be called multi-strategy funds, or funds of funds and things like that. But it's done in a way much more efficient way. And the platforms that are out there are growing very fast and are gathering a lot of assets from institutions. And it's a much more disciplined way, I think, of doing active investing. And we can go into that if you want, Gary, but I think it's a very interesting model. And I think 1 year from now, we're going to talk more about these platforms. There is a tail risk in there, which is if they don't get the risk management right, could be LTCM type situation. I think LTCM was the ultimate in some ways it was evolving to become a platform before it blew up. But modern platforms are getting and again, back to this thing about why risk management is so important. These platforms, one distinguishing thing about them is the very sophisticated risk management platforms that they have. So again, risk management is back at the forefront.
Luis, thank you for sharing your highly valuable insights and perspectives with us today. And to our listeners, thank you for tuning into Compound Insights from CFA Society New York. We'll be back soon with more conversations with leaders in finance. Until then, I'm Gary Farber. Thank you for listening, and we'll see you again soon. Financial service firms succeed through people, expertise, and long-term client trust. That's why Harvard Business School offers an executive education program tailored to the opportunities and challenges professional service firms face today. In leading professional service firms, a 5-day program on the HBS Boston campus, senior leaders will focus on strengthening their strategy while delivering outstanding client service. Guided by real company examples, participants will examine how leading firms align partners, build culture, and sustain growth in competitive markets. Learn more at hbs.me/client. That's hbs.me/client.